In June 2024, the Central Bank of Kenya's Monetary Policy Committee made a pivotal decision. They opted to maintain the central bank rate at its current level, reflecting their analysis of the economic landscape. The committee sees signs of inflation stabilizing and economic activities showing resilience. Yet, they remain on alert for potential risks. Factors like global economic uncertainties and domestic issues, such as weather patterns, could still sway Kenya's economic path. The decision to hold the CBR steady signals a vote of confidence in the measures implemented so far, aiming to foster investment and support growth. This cautious stance mirrors the delicate act of balancing inflation management with economic expansion, essential for the nation's economic health. The MPC's firm position suggests they believe the economy is on stable ground, yet they continue to monitor key indicators closely, aware of the challenges that lie ahead in a volatile global economic landscape. Their future decisions will need to judiciously weigh both internal and external factors to ensure Kenya's ongoing economic stability and growth. June 2024 also brought a slight easing of inflationary pressures in Kenya. Although still above the central bank's target, the inflation rate showed signs of moderation, thanks to factors like lower global commodity prices and governmental efforts to stabilize the cost of essential goods. Despite this positive shift, the cost of living remains a pressing concern for many Kenyans. Volatility in food prices, especially staples like maize and wheat, continues, driven by weather patterns and global supply chain disruptions. The government's role in shielding consumers from these shocks will be critical in the upcoming months. This dip in inflation offers a hint of optimism, suggesting that recent measures to curb rising prices are starting to take effect. However, the battle against inflation is ongoing. Addressing supply chain issues, enhancing agricultural productivity, and managing external shocks are crucial for keeping inflation under control. Commitment to fiscal discipline and targeted social safety nets will also be essential in lessening the impact of rising prices on vulnerable populations. Recently, the Kenyan shilling has shown remarkable resilience against major international currencies, a notable achievement amidst global currency market volatility. The shilling's strength is supported by robust diaspora remittances and sustained investor confidence in Kenya's economy. The Central Bank of Kenya has also played a significant role in stabilizing the foreign exchange market by strategically intervening to prevent excessive fluctuations. This has created a predictable and stable exchange rate environment, crucial for businesses involved in international trade and investment. However, the road ahead holds challenges. Global economic shifts such as rising interest rates in developed economies could pressure the shilling in the near future. Additionally, price fluctuations in key exports like tea and coffee could affect foreign exchange earnings. Maintaining a stable and competitive exchange rate will be crucial for supporting Kenya's export sector and attracting foreign investment. The central bank's continued vigilance and proactive policies will be key to navigating these challenges and ensuring the shilling's resilience against global economic headwinds. Government securities have continued to attract significant investor interest in Kenya. The relatively high yields offered on these instruments compared to other investment options make them attractive to both domestic and foreign investors seeking stable returns. This demand has helped the government to meet its financing needs and support its development agenda. However, the global rise in interest rates poses a challenge. Investors now have alternative investment opportunities offering potentially higher returns. This shift in the global investment landscape could lead to reduced demand for Kenyan government securities, potentially impacting the government's borrowing costs and its ability to finance its budget. The government faces a delicate balancing act, attracting sufficient investment to finance its spending plans while managing the national debt burden requires careful calibration of interest rates and other policy levers. Maintaining investor confidence in the stability and soundness of the Kenyan economy will be paramount in navigating this complex environment. Furthermore, the government will need to explore innovative financing mechanisms such as green bonds and diaspora bonds to diversify its investor base and reduce reliance on traditional sources of funding. By adopting a proactive and forward-looking approach, Kenya can continue to attract the necessary investments to drive economic growth and development. Kenya's economy, like many others, is not immune to global economic headwinds. The nation has been experiencing a series of economic challenges that are largely influenced by external factors beyond its control. These headwinds are testing the resilience and adaptability of Kenya's economic framework, pushing policymakers and businesses to find innovative solutions to sustain growth and stability. The interconnected nature of the global economy means that events happening far beyond Kenya's borders can have a significant impact on its economic performance. For instance, a slowdown in major economies like the United States, China, or the European Union can lead to reduced demand for Kenyan exports, affecting the country's trade balance and foreign exchange earnings. This interconnectedness underscores the importance of global economic stability for the well-being of individual nations. Rising global interest rates, fueled by inflationary pressures in major economies, are creating ripple effects across the world. Central banks in developed countries are raising interest rates to combat inflation, which has been driven by factors such as supply chain disruptions, increased energy prices, and higher consumer demand post-pandemic. These higher interest rates are not just a domestic issue for these countries, but have far-reaching implications for emerging markets like Kenya. These rising interest rates make it more expensive for countries like Kenya to borrow money on international markets, potentially increasing the cost of servicing existing debt and financing new development projects. Higher borrowing costs can strain national budgets, leading to difficult choices about where to allocate limited resources. This situation is further complicated by the need to invest in critical infrastructure and social services to support economic growth and improve living standards. Additionally, a stronger US dollar, driven by the Federal Reserve's monetary tightening, can make imports more expensive for Kenya, potentially fueling inflation. As the value of the Kenyan shilling depreciates against the dollar, the cost of importing essential goods such as fuel, machinery, and food increases. This can lead to higher prices for consumers and businesses, squeezing household budgets and reducing disposable income. The ongoing war in Ukraine and geopolitical tensions in other parts of the world add another layer of complexity and uncertainty to the global economic outlook. The conflict in Ukraine has disrupted global supply chains, particularly for commodities like wheat, oil, and gas, which are critical for many economies, including Kenya's. Geopolitical tensions can also lead to increased volatility in financial markets, affecting investor confidence and capital flows to emerging markets. Disruptions to supply chains, particularly for energy and food, continue to impact prices and create challenges for businesses and consumers alike. The COVID-19 pandemic exposed vulnerabilities in global supply chains, and the war in Ukraine has exacerbated these issues. For Kenya, this means higher costs for imported goods and potential shortages of critical supplies, which can disrupt production processes and lead to higher prices for consumers. Navigating this turbulent global landscape requires a deft touch. Policymakers must balance the need for economic stability with the imperative to support growth and development. This involves making strategic decisions about fiscal and monetary policy, as well as implementing structural reforms to enhance the economy's resilience. It also requires close monitoring of global economic trends and proactive measures to mitigate potential risks. Kenya will need to leverage its strengths, such as its entrepreneurial spirit and growing digital economy, to mitigate the negative impacts of these external shocks. The country's vibrant tech sector, often referred to as Silicon Savannah, has the potential to drive innovation and create new economic opportunities. By fostering a supportive environment for startups and tech companies, Kenya can harness the power of digital technologies to boost productivity and competitiveness. Building resilience through economic diversification, promoting domestic production, and strengthening regional trade ties will be crucial in the years to come. Diversifying the economy can reduce dependence on a few key sectors and make it more resilient to external shocks. Promoting domestic production can help reduce reliance on imports and create jobs, while strengthening regional trade ties can open up new markets and enhance economic cooperation within the East African community and beyond. By taking these steps, Kenya can build a more robust and sustainable economy that is better equipped to withstand global headwinds.